Peter Eliades with you again. This is Monday, December 23rd. Stock market cycles update. Basically straightforward and simple today. Just going to repeat a few things and show you what's going on, in our opinion, in the market. We showed you this channel last week and we told you how important we thought it was. And obviously today it held too. The reason why we believe this channel is so important is that because it's comprised of three of the most important turning points of the last 3 or 4 years. Few people would argue that this second low, there was a January-February low in early 2016. Few people would argue that this was not one of the most important market bottoms of the past 3, 4, 5 years at least. The second bottom was December of 18, and that, obviously, if you look at the chart, you can see it was also very important. Now, the interim high there, you can say, well, this high was as important, and this high is, we surpassed that long ago on the S&P. But remember, this January of 18 high was the high on the New York Composite Index up until a week or two ago. So this was a very important high. It's just been surpassed on the New York Composite Index. And is that going to turn out to be important and an important breakthrough? I don't think so. Time will tell. And we're in a zone where we should know very quickly. But these 3 points determine the channel. And finally, this channel could have been determined right after a big rally off this low in December of 18. When you get into around this area, you'll say you could have drawn these lines and said, okay, here's a bottom, there's an interim top, let's draw the line and see. And then you'd say, oh man, we're never going to get up that high, are we? I mean, I felt that way at the time too. We're never going to get it back up there again. Well, guess what? We're there. So this is the weekly chart. This week, 3230.52. It says next week, but next week was Friday. That's this week, 3230.52. But let's do this. Let's show you the daily one. The daily one is fun too. I love to do the micromanagement type stuff. So here's the daily one. Exactly the same channel, but obviously we're working with trading days now rather than market days. I didn't put all the numbers down. I'll tell them to you if you want to grab a pencil or pen and go back and watch the video a couple of times. You'll have the numbers. The low down here was 1810.10, which, by the way, we mislabeled on the weekly chart we showed you. We had the number of days rather than the price low on the weekly, so you can make that correction. But this is 1810.10. This low is 2346.58. This high is 2872.87. The distance between these two lows is 723 trading days. So you simply take the difference in price divided by the number of trading days, and you get the slope for points per day that the line is moving up. It turns out to be 0.742. Obviously, these numbers are going to be different than the weekly numbers. Then you work with a high in January of 18. That high was 2872.87. And then you find out how many days until, let's say, today or Friday or whenever you're doing the calculation. This is 480 days through today, December 23rd. You multiply the 480 days times the 0.742 points per day, and you come up with a calculation that today, this line on the daily chart is at 3227.78. Tomorrow, it'll go up 0.742 points. So you can follow it this week. It goes up 0.742 points per day. So today, it was at 3229.03. What was the high today, folks? Well, let's take a look. The high was 3227.78, 1.25 points away. That was certainly enough to satisfy it. You're not going to argue over 1 point on the S&P. So the bottom line is we should be at some kind of top. Do I think it's going to be the final top? No, if you're a technician, you would guess it's not going to be the final top. But look where we are. I mean, we're there. We hit that upper line after working at it all year long. Literally all year long, we finally hit that top line. That should stop the market in its tracks, okay? If we get above it, you'll know quickly and you'll say, okay, that channel no longer exists. I don't think we're going to do that. So the most likely scenario now is a decline from here, and then going into perhaps early January, back up towards the line again, maybe to it again, maybe a little bit above it again. But those are the points we're going to watch closely. Why do I say I don't think we're at the top? Well, there are several reasons, but one of them is, we showed you this several times, the daily AD line. Look at the daily AD line. It just keeps going up. You don't usually reach important market tops when the daily AD line is making a new all-time high. But look at the channel on the AD line. It hit the top of this very short-term channel today. So then again, that kind of amplifies the thought that perhaps we're going to have some kind of decline from here. From that decline, another move up into the beginning of the year, into January, and at that point, perhaps we will see divergences in the advanced decline line and some of the other indicators we look at. 52-week highs. Friday, the 52-week highs were 272. That's the highest number since June 20th and July 31st. They were 319 and 326. So you could make a bearish case out of that. The number of 52-week highs is going down as new market highs are being made. So it's just another piece of the puzzle that we're going to be watching over the next couple of weeks. That's where we stand. We think we're at a top, at least short term, coming down, perhaps going back up again into the end of the year. That's it. Thanks for watching. If you haven't subscribed yet, bottom right, YouTube, click on the red banner, and then once you do that, click on the bell. You'll be notified of all these updates. Thanks a lot for watching.